Good morning all, I hope you are well and welcome to another one of my videos. So today I have two pairs on watch, those are dollar yen and Aussie Kiwi. So I've just put Aussie Kiwi back on watch and I shall explain why once we break down that pair. So I'm going to start off with my favourite of the bunch. Both of these lower risk positions today in my opinion and experience. So I shall touch on why as well when I get down to the actual entry. So dollar yen, my favorite of the bunch. Why am I looking at this? Well, even if you're very, very new to trading, you can see that we are at a significant high here. You can see that this is an area that people will be paying attention to. This is an area where I would anticipate the buyers getting out of their positions and the sellers getting in. Okay. We have, if we just zoom to the left, it's always important to look left. There is nothing to the left. There is nothing above price. So this is a very, very significant high. And what we know about the very, very significant highs, particularly on the higher time frames, we typically break above and catch people the wrong side of the market before we see the bigger moves to the downside. And the same is true on the flip side. Do excuse me if you can hear that noise in the background. That is my dog. I don't know what he's doing. Right, hopefully he's stopped now. The joys of live broadcasting. Anyway, okay, so yeah, we typically break the highs before moving to the downside if we are going to see a big move to the downside. So what do we, if we just zoom in on this price action, you can see that we near missed to that high. There was a lot of, not everybody who sold here had FOMO, but there will certainly be a lot of traders in here who sold out of FOMO, fearing that this move was going without them, knowing full well that they were actually supposed to stick to their plan, which was likely to wait for price to get to this area. Price did get to this area and then it starts to sell off. Okay, but as I've just explained, typically speaking, we break above the highs before the bigger moves to the downside, which probably explains why all the way down we see these sharp pullbacks. Sharp pullback, quite sharp pullback there, very sharp pullback there, another one here. This is usually orders that are still up here, dragging price up, and orders that are being placed here dragging price up, meaning that we need to fill those orders before price can move down in a more fluid manner, which would be something like this, these tighter corrections without typically these sharper pullbacks. Sometimes we get them if we're retesting something, but when you just see sharp pullback after sharp pullback, that is a very, very good clue that we're likely to break the high before that bigger move to the downside. Okay, and we have a bit of a sharp move is often, as I said yesterday, often either liquidity, either price being dragged up by liquidity or a big exchange of liquidity. So we have a sharp move here and we tap into it by way of a reversal structure. Okay, so we break below that, we see the reversal structure. Once the liquidity that was sat below here is washed out, then those orders which were dragging price up here start to drag price up. Okay, and then we see more of a natural sequence of impulse correction, more of a running channel, this one, but an impulse correction continuation. And then once we start to get towards that significant high, that higher time frame high, we start to see these structures which we typically see, these reversal structures. So we have the first drive to the downside, second drive, and now we're in that area again, but once again we haven't yet broken above it. Okay, so these are repetitive, this is just human psychology, which are, as I've said before, is loosely based on Elliott wave theory, which was discovered in the 1930s, and the data that was used in that discovery dated back to the 1860s. So if human psychology, where the market is concerned, has repeated itself with statistical reliability since the 1860s, there's no reason to think that human psychology would be changing anytime soon. Okay, you can see here, this is exactly what I was anticipating as well. We haven't yet broken the highs, and we have this area of consolidation here. So it was my anticipation that we would likely break below, wash out all the liquidity that was sat there, especially when Such a washout would be the retest of the back end of all of this liquidity where there was a sharp sell-off. Okay, and what happens? We wick just below, which is what I was anticipating. We wash out that liquidity, and now we're moving to the upside. Okay, so as I zoom in, just unpacking the pieces of the puzzle as they appear to me, as they jump out at me. I'm just going to take this, so we can see this overall area of value. So I'm just going to take this ray line off the chart now, just for simplistic reasons. And you can see that once again, we have the area of value. We near missed to it. So this, to some extent, was likely a bit of a FOMO move. They're not normally this impulsive, but one of the reasons they may have been impulsive is because of all the liquidity that was sat there and the fact that it was a retest of the back end of something. So if there's significance, sometimes these middle sections can be a little bit more impulsive versus the corrective manner which they usually move in. Okay, so we've near missed again. You can see that we've near missed to that high, and although this looks quite far away from the area of value at the moment, there is a lot of economic data coming out of the United States and Canada this afternoon, and that may act as the catalyst which drives price up to this area of value, excuse me, a little bit more quickly than we otherwise might have anticipated. So with all of that in mind, what I'll be looking for today from this pair is the following. It's the same as I was looking for yesterday. Okay, you can see that price tried to sell off again. We have a little bit of a FOMO channel. Price tried to sell off, and you can see that it's reaching for liquidity. Okay, what we might get, this may not be ready by the end of the day, what we might get is some kind of little reversal structure. Okay, so when these corrections become very wide, or we pull back a lot of the move, okay, a significant portion of the move, that can often be an indication that we're going to get something like this, where we tap into this sharp point there, and we end up with this 1, 2, 3, and then we break the high. Okay, and that would take a little bit longer, and then we would once again have that first drive, second drive, and then this would be the third drive. So if that happens, that this may not be ready till maybe tomorrow or Friday. Okay, but because you can see price reaching, and if we just zoom out, I'm just going to check something. See that big wick there? That is often a good indication. That is often a good indication that liquidity was grabbed, and that may indicate that we've already grabbed enough liquidity to send price up to the area of value. So just piecing all these different things together. So what I'll be looking for from this pair is if price taps into the area of value, okay, we will likely break above. If we do, I'll be looking for a push back down, and either so an impulse back down on the 1 hour chart, and I'll be looking for a 5-minute continuation, so 6 to 8 corrective 5-minute candles as a minimum. And then I'd look to get short with a reduced risk entry on the break, or if it was a 2-touch 15-minute continuation, I'd look for a 5-minute risk entry within the flag if I could get it on the 5-minute chart, or a reduced risk entry on the break, whichever shapes up, whichever entry I'm able to get. And then I'll be able to manage it down to this sharp, this first target there, this first sharp point for something in the region of 2.5 to 3%. And then my target would be down here. And that's where I would use the mechanical management tool, and I would measure from range to range, and I would set a take profit at the 90% mark, which is where price typically pulls back sharply, even if it is to continue in our forecasted direction for something in the region of 9.5%. Excuse me, depending on the size of the stop loss. Okay, so that's what I'm going to be looking for today. There was something else I was going to touch on, but I've forgotten what it was now. Oh yeah, that as I said, this is the tool that I use here that I've just loaded up. So I asked myself, am I well positioned for a move to the downside if that entry was to shape up? Yes, there's nothing above it that we need to concern ourselves with. Am I positioned well on the lower time frames? Well, by that point, yes, I would be. That would be very well positioned. What would the sequence look like? Well, if that was the first flag and it looked like that, the sequence would be fine. If the market was to take me out, why would it do so? Well, it would likely be trying to find liquidity above price. Okay, so we can try and draw something on, but there is no liquidity points above price. So therefore, there's no logical reason why price would do that. even though price can do anything at any time. So if the market was to take me out, what would it look like? Well, I can't really draw it on because there's no liquidity points above price. So based on the above, is this entry low risk or a higher risk setup? And the answer is a lower risk one, okay? Because there's not really anything else that price could form. So that is dollar yen, okay? So we have Aussie Kiwi. Aussie Kiwi just starting to do now what I've been anticipating. Okay, Aussie Kiwi can take a long time to do things just by the nature of how it moves. Okay, it is a very corrective pair. So on the daily chart, I said I'm going to try and stay on the daily for the purposes of these videos. So one of the reasons this is lower on the radar for me is because we have a series of near misses to the upside. Already, this slightly increases the risk because if we have near misses to the upside, then these will likely be filled versus dollar yen, which is at an all-time high, which is a much lower risk. Well, it's just a lower risk position for sells if you're, obviously at an all-time high, depending on how you enter. If you enter too early, then obviously it's not. But you can see here we have these series of near misses, but we also have this significant area of value. Where do you think, if buyers were involved in this move here, where do you think they would likely be getting out of their positions? I would argue here, okay, and this is a prime example where the sellers would likely be getting in. Okay, there's nothing particularly complicated about this. And the other clue, this is what we call nature theory. How did we reach this area? Okay, we have reached this area very correctively, and this move has taken approximately 3 weeks, 2 or 3 weeks to form. Okay, this is exhaustive price action. This is not typical, even though this has been an impulsive move up or overall, this corrective last part of the move, this is not typical of something where price just does that and then tags you in and then just blasts to the upside. Okay, price needs to typically build volume. So even if price was to move to the upside, we would usually see in this area something like that, price building volume for that move to the upside if that was going to occur. It doesn't normally just move up like that and then just drop out, which is what you're seeing now, okay? However, you can see that this correction started here, right? You can see where price started to correct to the area of value was here. Prior to that, there was an impulse up. So what this could be a move like this, something like this, where this becomes a larger bull flag to then push higher to take out these highs which keep near missing to each other. And then if we measured the overall impulse and we assumed that the continuation leg out would be of a similar length, that would take us up to this sharp move, which was the sharp move that all these highs keep near missing too, you can see, okay, which was also, just to touch on it, it was also the exchange of liquidity which caused price to smash through all of these lows, suggesting that there must have been a lot of liquidity in that area. So then therefore contextually a move down to here to give us some kind of bull flag to push higher to take out that high makes sense. So that means that we could potentially capitalize on excuse me, on a move down to the area, okay? Just a shorter term move. You can see that this candle here has dropped out so far. If we just study the price action a little bit more in a little bit more detail, you can see that we have this overall range, this corrective range. We then stall in an area where I would want us to stall, and then you can see that we've just dropped out now. We have a 4-hour candle. What I like about this, let's have a look. Yeah, what I like about this is we have this 4-hour candle with quite a big wick above it. We do have a little bit of a wick below it, suggesting that price may consolidate for a period of time, and that is a factor in my forecasting. But we have a big wick above there and just a dropout below all of this consolidation, which if you watch the video or videos that I made earlier in the week, or Monday or at the end of last week, that's exactly what I was anticipating, and that's exactly what's happened. Okay, so with all of that in mind, what I'll be looking for now, if we just look at this in the 15-minute chart, so you can see that drop out there, if we just look at this on the 15-minute chart, price has left a footprint. See this sharp move up followed by this sharp move up, and you can see price reaching towards that. That implies that once we dropped out, there was liquidity placed here, okay? And if we just measure this impulsive move, so where the impulse started, that would be a pullback of about 40%. So if we were to pull back to this region, that would be a healthy correction relative to the move down which has preceded this. So preceded this dropout. So with all of that in mind, what I'll be looking for is the following. This may not be ready by the end of the day, okay? But what I'll be looking for is I'll be looking for a 3-touch 1 hour continuation or a 2-touch 1 hour continuation with a 3-touch structural approach. So if we moved up to that sharp hook point by way of a, let's try and get the paintbrush tool on the chart. So we have the sharp move there. If we moved up to that by way of a 1, 2, 3, okay, then I would look to get short within a correction like that, or a 3-touch continuation such as something like this as I've drawn it on, okay? And then I would be able to manage it. I've kind of got this on as my first target. I've got that low on. There's a series of lows, but I don't think they hold much significance. We've got this one here, and the reason I've got that as my first target is because if we measure this impulse here, and we assume that the leg out would be of a similar length, that would take us down to there, okay? And then the start of this correction, which I was talking about, ends here. So that would give us something, just a short-term move in something in the region of 6%. And then I would use the mechanical management tool and I would set a take profit there. So that would be something in the region of 5%. We may get a slightly tighter stop loss, okay? And then I would trail my stop loss accordingly as well. So just a little short-term move, which just so happens to line up with that little sharp move there, but that's not really of any significance. And then the question I ask myself once again is, would I be well positioned for a move to the downside on the higher time frames? Well, if we just zoom back out, it's important to do this. Yes, I will be well positioned. Yes, there is an area of liquidity up there, but it's so far away, it's not really something to concern ourselves with. So that would look very nice on the lower time frames. That would be indicative of a move to the downside, so I'd be well positioned. Would I be well positioned on the lower time frames? Yes, because we've dropped out of all of this consolidation now and we're trading underneath this. What does the sequence look like? Well, since we tapped into that area of value, the sequence is a little bit atypical, which is why I've got a silver tick there, not a green one. You can see we move down and then we pull back about 80% of this move. Sometimes this happens, but we pull back about 80% of that move without tapping the previous high before we dropped. So the sequence is not typical. We then did the same thing here. Okay. But the good thing is we've kind of negated that by virtue of the fact that we've completely dropped out below this. So I'm just mindful of the sequence slightly, but so that's partly why this is lower down on my list. Regardless, if my entry was to shape up, if the market was to take me out, why would it do so? Well, if the market was to take me out, it would be because it's trying to find liquidity from somewhere. Okay, so where is it trying to find liquidity from? Does it need to find liquidity from here? Well, not really. Does that look normal to me? No, it doesn't look normal to me. Okay, because as I said, the next liquidity point is all the way up there. So price has no business, if it was to form this entry that I'm looking for, price has no business coming all the way back up. Okay, if we had a 3-touch like that, that would be very deliberate. We've dropped out of all of this, so there would be no reason for price to just suddenly do that and do that. That doesn't really make sense contextually. So therefore, based on the above, is this an entry low risk or a higher risk setup? And the answer is a low risk one. Okay, if there was something sat just above, or I was taking a tiny little correction there, you could easily be tagged in and tagged out, but we've completely dropped out below all of that now, suggesting that there wasn't enough liquidity here to send price to the upside for this to be some kind of bull flag. Okay, we don't normally drop this far out and then consolidate sideways and form a deliberate correction. So that would make this a low risk position. I'm about to run out of time, but that is I hope you've enjoyed this video. I got a bit carried away there. I have an alert set just below that little hook point on the 15-minute chart to see if we can push up to that area. And if that does not trigger, then I won't be looking to place a trade. I hope you've enjoyed this video. Thanks for watching, and I'll see you again in the next one.